I was able to define the new corporate strategy, and obviously before of that I had to define that what kind of problems the company has. We know that low launch numbers because of lack of reusability, so they have excessive expenditures because they are manufacturing stuff which should be not necessary, but they were lazy to develop their partially reusable launch vehicles, so that's why we have to do it instead of them, because we would like to keep the company afloat on its own, not from taxpayers' money. And as a result, I made this beautiful new design from different components available at the market, and yeah, it's made from aluminum, and I'm trying to use the Prometheus engine, which is now on the test bed, so hopefully it will not explode so much. Then, please design your own vehicle and estimate the changes in your profit and loss statement. And we can see that, okay, I had to stop here. So we have the new launch vehicle, and also we have the new launch numbers. But after that, I had to stop there. So, okay, we need to provide fancy numbers because this is what is preferred. So, how can we highlight that we are improving our profitability? And this is estimate. One hand, we could just copy and paste the profit and loss statement into the document, and we would be really happy about this. But come on, guys, we should do it better. So that's why we can say that at least we can compare the EBIT, old EBIT, new EBIT. Also, we can compare profit of the year. Also, we can compare stuff like cash reserve. So in this case, we can highlight some nice changes in our ways of operations, and more also improvement. So in the case study, team is set up, then let's create original data. So can we say that revenue, people are also prefer to report revenues. So original revenue. Then obviously we have to show or indicate what happens with the operational profitability. So yeah, EBIT. We can say that original revenue versus the current revenue. This one is can we put everything into one graph? Maybe it will be a mess. Okay, let's not do that. Okay, so let's pick EBIT. We have the similar rows. Maybe we will skip profit of the year because what we are interested is in cash. So now we can say that, okay, we have revenues, we have EBITs, and also we have the cash reserve. So with these three graphs, we can highlight that our profitability has been improved a lot. Okay, we can add that these things are in million euros, not in bread, but that would be just fancy formatting of things. Okay, so due to higher launch numbers and lower manufacturing costs, maybe not lower manufacturing costs due to higher efficiency, because launch numbers and efficiency, because we don't have to manufacture some of our key components, so that's why it's higher efficiency or productivity. We are saving work hours and manual labor, so this is productivity at the end of the day. Revenues, EBIT, and cash reserves were increasing substantially. Okay, do we have any other questions here? No, we were able to prove that, okay, questions are answered, profit was increasing, and also we have the new asset. But still we have to further questions to answer. So first of all, we did not define anything about funding for the new strategy. Also, we have to define later on that what is happening with sensitivity towards funding costs and also exchange rates. So right now these numbers are really nice, just we cannot say that, oh, now job is done, because sensitivity analysis must be done. And also, obviously, impact on value and probability of default should be explored further. So this was, let's pick this one, and I will save it as assignment 2 sample. Value and probability of default. So the question is the following. Maybe I would change the ordering here. So first of all, we should explore what happens under inflation, and then the fundamental value, then distress analysis. So all these three things should be added there. And we don't need that one. Maybe we should keep the design, or maybe we will delete it later, but right now it can stay there. So, corporate performance under inflation. First of all, there are two kinds of inflations. So, we can assume that all revenues and let's go back to here because so manufacturing prices, so unit price and unit costs will be changing because of inflation, but not because of consumer price index, but because of producer price index. So they should follow that one because this is the right inflation for them. Revenues and will increase to follow the rise of producer price indexes. While obviously wages should reflect on consumer price indexes. That's one thing. Second thing is that if we are checking if we are operating only on a competitive market, then we will see that companies, according to traditional microeconomics, they are price takers. So they are suffering from inflation because their expenditures are rising, but for them it's really hard to increase their prices as well because they would immediately lose their competitiveness. Luckily, we are in a highly oligopolistic situation, so still there are not much orbital launch providers on the market, especially that we are paved or cushioned heavily by taxpayers' money, so we can say that we can increase prices if we want. We know that there are limits, but within these limits we can do something like this. So that's why we are in an oligopolistic market. So since we are operating on an oligopolistic market, we can consider that both our revenues and expenditures or expenses will follow inflation, unlike on a competitive market. So that's the key difference. That's why this is the power of marketing. So if you can highlight your customers that our product is unique, at least if you can convince them somehow, then it can be a really powerful tool to fight against inflation, or sometimes even you can increase your prices higher than inflation because you are saying that, oh my god, my expenditures were increasing. Practically your margins will increasing. So if you have any chance to grab to increase your margins because of inflation or some other shocks, then you have to do it because it's good for profitability. So until demand is not shrinking too much. So that's why we have to be really happy that this company is on an oligopolistic market, and we are not just selling potatoes on a market where everybody sells the same potato. Rockets are a bit more complex product than that. So now we just need the trajectory for inflation. So what are the inflation forecasts? And in this case, we can say that luckily, European Central Bank has an inflation forecast database. Now I just have to find the proper... It's always the first or second one. Let's check the first one. Yeah, still waiting for the cookies. Trucks and costs. So we can see here the expected consumer price index. And we can see that, yeah, we could say that, oh, we are excluding energy and so on, or we can focus on services, but we don't care, so this is completely fine for us. That this year, sorry, last year, this year, and then 2 years ahead, but it should be longer, so we will check for the proper data. I'm looking for also producer price index. Also, they are looking for wage development, so if we are precise, then we can say as well that, oh, we don't care about inflation, we are just focusing on wage projections. But since we are highly motivated to provide affordable living conditions for our workforce, that's why it's much better to give them at least a raise which compensates inflation. So alternate pass, blah blah blah. Yeah, but they have a better website for this. The ECB website is absolutely terrible in terms of accessibility. Oh, come on, this is also not the proper website. We have real GDP, we have HCPI, everything, just not in the... Yes, this is what I was looking for. So, on the same, for the same central bank, but on the different website, we can see that this is the newest forecast. And in this case, we can see that the current calendar year, next year, 1 year ahead, 2 years ahead. So this is what we have. Okay, right now it's not that interesting because everything is around 2%. But if we are going back, then we can see that it could have a message in the past. Right now they are happy because they are really close to targeted inflation, so they don't have to. Are you happy with this page? Yes, I'm happy with this page. Someone should have higher salaries because of this. Okay, so let's update because we already have inflation. So this year, 1. Next year should be considered that this will be a higher number. 1 year ahead, so we have to look for this column here. So it's just 1.8. Yay! Lower. Then 2 years ahead, it's 2.0. So we can see disinflation. Not deflation because it's still increasing, but less. Okay, a longer term, 5 years ahead, is 2%. So now we can project that, okay, it will fluctuate around the targeted inflation, which is cool. We can say that, sorry, harmonized consumer price index. And it's coming from the ECB's website, so I'm also adding the link to their page, and then we should check that, okay, it's this data is coming from, yeah, coming from the wrong place. So because after that this 9 D9, yeah. So you can see here that in the case of pricing, cumulative effects of inflation has been added, but this is not the proper inflation. So this is good, just we need better. So I'm adding an additional so we need PPI inflation forecast, if there is any. Sooner or later we can see. And cumulative effect of producer price index, not this one. So let's check that. Do we have ECB producer price index forecast? ECB doesn't publish dedicated PPI forecast, but rather a broader macroeconomic projection for EU area. Headline core inflation, blah 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 blah. One on this. I will just create some artificial date for it, and maybe it will. Yes, now you can do it. Okay. So this is what we can get from Excel if we have proper dates. Right now we can ignore what is happening here in the level of dates. So it says that inflation or producer price index can be anywhere within the confidence interval, and unfortunately right now this confidence interval is not significant because it says that the medium line is negative while the upper band of confidence interval is positive, lower is negative, and all of them should be negative or positive. So if we have mixed signals here, then this one is not working at all. So this is absolutely confused. What should happen? So in this case, we just pick the historical mean. It's terrible, but it's still better than nothing. So, okay. Then let's say that we are just taking the mean and then we are going home happily. Is it better than CPI? No, it's absolutely not. So we can see that it's again 2% on average from the last decades. So congratulations, I made completely no effort whatsoever. does it worth to explore this further? Okay, this is the original. This is the CPI. Because we are still reflecting on what happens here. So now at least numbers are proper, and then we can say that, yeah, it's also 2. So 1 plus u. Yep, and obviously u should be divided by 100 because otherwise it would be misleading. And we have to use dollar mark. And then point. And also we are saving that this beauty was coming from here. And then we can say that, okay, now it should be also updated. Why it's not linked back here? So we have updated many things, and now we get completed the same numbers, but at least with higher sophistication. And so our revenues are increasing following the cumulative producer price index. Also our expenditures should C9. Yeah, it refers on C9, so it's good. Also it refers, but wages, now it's not C9, it should be HCPI. So instead of this one, now it should C40. And now this should be not that way, because now it's a cumulative effect. So last year multiplied by 1 plus, well, not 1 plus because it's already 1 plus, so just u. And it just walks through and increases a bit. And now we can see that, okay, we are reflecting on inflation, even if it's utterly useless. But we have to highlight it. Now we have a graph. So we can say that. Source, we can say ECB, kind of, sort of forecasts. So now we can see that, okay, this is nice. Yeah. Now please evaluate company fundamental value. What is the fundamental value of your shares? This is the more interesting part, so sorry for this delay, but now we can check the discounted cash flow. Luckily, all of these things are mainly or mostly calculated, so we still should check that is this valid or not. So let's check valuation. So EBIT from the profit and loss statement, it should refer to C20. What is in C20? The EBIT is there, so okay, it's good. Then it rolls through, so EBIT is okay. Then we have corporate income tax. C30. Yes, it's in France, it's 25%, we can remember on that. So this is good. Gained interest. We don't have in the first year gained interest because that would create circular functions, so that's why financial revenues are 0. Paid interest. Yeah, it's just now this is the corporate income tax. C24 is paid interest. So hopefully there is not much an issue there. And also we can see that this thing is summed up as taxes, and this is plus, this is minus. Spending on investment is 0 because we are ignoring that we are doing any kind of an investment. It would be really hard to assign any kind of a number, so that's why it's 0. If our business plan would contain such a number, then we would include it, but right now we cannot. Then C19. C19 is depreciation, so this reference is good. Then floating capital. If we would have proper cash flow report or cash flow statement, then there would be floating capital there. Unfortunately, since we don't have anything like this, that's why we have to assume that if we are taking M5, which is cash reserve, so current assets. So cash reserve and inventories all together will represent the current assets. I would like to exclude all the other non-transparent categories, so that's why this and that were included, and minus M16, so current liabilities. I don't want to include the other liabilities because we have no idea what is that. So that's why only transparent items are added, because otherwise we would have really strange numbers here in case of the valuation. So this would completely derail the whole valuation if we would add the non-transparent data. So after that we can see that the free cash flow is the sum of this positive number 4 minus the taxes, which is 1, plus depreciation because this never left the company, and also plus floating capital because this is there as well, so there is no missing data or wrong sign, so we can see that this is steadily increasing and happy. Then we have the weighted average cost of capital. This is what we need for discounting the free cash flow. And in this case, we can see that, okay, first of all, we have to declare that what is the importance of shareholders' equity. If you are checking the balance sheet, then we can see that long-term debt is 3 million euro, while common equity is way more. Why is this 100 there? This will be my additional financing need, but right now I don't have this. So, yeah. And also I have to check that in the original setup, we had also this 100. At some point I added it, but right now I don't want to. Because also cash reserves were not increased, so that's why. C33. Yeah, only annual, and the depreciation, which is an artificial expenditure, is there, otherwise it's good. So we checked shareholders' equity. Still, it has a relevance of 99% because we are just taking equity and divide it by equity plus debt. So after that it will be 99%. Good enough. Relevance of long-term debt 1% because 100 minus 99%, then it will be 1%. Then also we know that what is the interest rate of our debt. because it's defined in C35. Let's roll to 335. Why is this like this? Because interest on debt is for BBB rated bond yields. We can see that this one is mimicking that one. So we can say that, yeah, but come on guys, this was last year. So what happened since then on the market? And hopefully I can log in and I can check it. So launching the former definitive icon database. Yes, I should be added. And in the definitive icon database, now it has been rebranded to LSEG Workspace. Doesn't matter. So now it's owned completely by London Stock Exchange, and they are creating their own brand, which, okay, this is their company, so that's their decision. Just, I think it looks ugly. But fixed income, then loans. I know it's corporate bond, but they changed the menu system, so now it's under credit, which is stupid. Then EU. In the 2 years ago, they had data set also for France. Now we have only for EU. I don't know why it's better. I think it's not, but yeah. So if we are checking what is happening in BBB rated companies, we can see that the decline in the yield curve, as inflation was decreasing, as key policy rate at the ECB was decreasing, we can see that also it became cheaper for us to fund the company. So if we have to update this, we can be even more stricter. So we can say that the company is so rubbish that we can downgrade it to BB. So at least we can have higher interest rate still. So for 1 year it will be 3 point something something. Two years ahead it will be 3.3. I was so happy when we had higher interest rates, because I was able to keep this class to highlight that funding a company through debt is expensive. Now I cannot do that because interest rates are close to 3%. And yeah, we don't have data for 4 years. Why? Because they are not providing it. So we have to pick the data from the 5th year, and then we just have to calculate an average. So linear extrapolation is used here. So this one plus that one divided by 2, it gives us that, okay, right now what is this? Corporate credit curves. In the EU. So this is the actual official data, and now we can say that, okay, the interest on debt is this. We had really nice BB rating in the past, or BBB rating in the past, but now it's just BB. Okay, interest on savings. Since we are updating the data set, then we just have to say that, okay, interest on savings, it should be French government bond. So why? Because it's easier to find the data. So okay, fixed income. Fixed income. Wow. Okay, I was kicked out. So no? No. Okay, so there is no fixed income right now because but I can collect it from elsewhere. Okay, let's ignore that part because for valuation we don't need French government bond. What we need is expected rate of return from the equity. So from expected rate of return from equity, we should use the capital asset pricing model, and in this case we need risk-free rate from 10-year government bonds. It's way better than 1 year because it fluctuates less, so it's more stable. We need market return, we need beta from the industry, from the Damodaran database, and in this case we can just pick up this. So the Damodaran database is total beta by industries in front of my eyes. So total beta Europe. This is the most recent data from January of 2025. And if we are going into aerospace defense, then we can take average unlevered beta 1.15. Wow, it's increasing, so we have higher risk than before. Oh, cool. Even if the leverage is assumed, it will be even higher. Let's pick the higher number. So interesting. So now, as it's higher than 1, it shows that aerospace and defense sector is more riskier than the market average. So at least we see some kind of a story here. Then we need a 10-year government bond yield, and as my friends were kicking me out from the LSEG database, then we have to go to our friend Stoku. Stoku is a Polish website. Sometimes it speaks Polish, sometimes it speaks English. But it's free. Once I can find what I'm looking for. Yeah, so French government bond yield nowadays, so the last known data is 3.5. So we can say that, oh, it's increasing. Oh, and we would have the whole... Yeah, this is what we are missing right now, because French government bond data should be imported from here. Just I cannot import this right now because of one of my colleagues who's not supposed to use this one. It's good enough. But what I would like to show you that how can we estimate the level of the market portfolio's return. And last time I was showing it, I think, that so this is the French stock exchange. Just we have to update the numbers because the last one is from 2023. And then we just have to make the exponential moving average EVMA with the lambda defined by the Goldman Sachs in the early 90s, and after that we will be really happy. Okay, so CAC 40 is the French market, and then we just have to pick historical data and annual data, it's already there. And now I'm also copying the URL here because it can be useful. The benefit of this that we have to do it only once. Okay, so let's see. What do we have here? Opening day. Oh, sorry, this one. How do you have December data for this year? Okay, that one is a database anomaly. But the rest we can capture. Then, once we collected the index data, then we just have to take, okay, what is the difference? Yeah, it rolls upwards. Then we have to take the... no, you are here. The third year. Tip. And also upwards tip. 2. Lambda is the same, so it doesn't matter. This is just math. And then we have to say that RM should be updated. Now we have additional 2 years and also the year component. It's not, instead of K22, now it should be K24. So we have 22 years. It's still 3%, just obviously if I would add more decimals, then it was changing slightly, but not much. Because this is the key problem here, that 1 year stock markets have a tendency to decline a lot, then it's increasing a lot, so that's why we have to use this exponential return, because in this case past big changes will be less relevant for us if we are just decreasing their relevance with the exponential averaging. And now finally we have the expected rate of return from the equity, and this is highly an anomaly. So expected rate of return should be always bigger than interest on debt. So this is what we can see. This is an anomaly. I mean, we are not meeting textbook requirements. Unfortunately, when economy is stagnant, when companies are not growing fast enough, this is what can happen. It's not a sign of a healthy and growing economy, unfortunately. And then we... oh, one thing is missing from expected. Yeah. Because we can see here that A multiplied by RE is good, T multiplied by RD, but 1 minus 2.25. This is how the proper function would look like. And also I have to do the same correction because yeah, this is also missing from here. Yeah, it's easy to forget it, but we should not. Also, we have to update the beta from industry, so you are updated. And also we have different numbers here. Yeah, okay, I cannot do that. You know, no, this one is still rubbish. So let's check for the... Okay, this is good. Then why do we have... Ah, because it's Q22. Sorry, Q24. Now it's the same. Okay, so see what is maintaining. Was able to maintain the parallel funding costs. Still, something is not right here. I don't know what, but it should be not that relevant. Okay, so now we have the discounted cash flow data. So after we were picking up the free cash flows here, then we are just calculating the present value with the weighted average cost of capital here. And then we have these numbers. And obviously the good news is that these numbers in the original company are lower than the modified with the new modified strategy. So we were able to contribute to value growth. Then salvage value. So we have to see in case of, yeah, there is. So in case of property, we have to evaluate everything in the far future. So that's why profit and loss statement Q10. Q10. Yeah, so after depreciation in the books, this is what we have. This is a terrible approach, but we don't have anything better. In real life, we would ask a company, real estate oriented company to provide valuation for this exact properties, but obviously we don't have this capacity right now, so we just have to take the book value granted. Also, we have the cash reserve, which is always nice. This is there. It's good, healthy. And, sorry, the intangibles. Intangibles are also, we should check it because we know that this is a paradox, or not a paradox. This is a problem that if we are checking that the intangibles are highly, or one of the most relevant assets. So, okay, cash reserves now they are also relevant, but otherwise, intangibles have way more contribution to valuation or to value than sometimes the profit. So if you are just checking the original setup, that even in the 5th year, the company is making some nice discounted cash flows, but intangibles are in the sky. So So in the original setup, we can say that mostly the value is coming from the intangible goods, not from profit, which was made by the company. Now it's more balanced. And of course, there is a salvage value itself. Then we have the value generated from the discounted cash flows plus the salvage value, so all these specific asset elements. But this is the value for the whole company. So after that, we have to remove the debt. Okay, right now the debt is 3 million euros, so it's quite simple to see that, okay, the value of equity is the same. And now we can see that I was able, wow, it's not even doubling, it's even more. So I was able to multiply the value of the shares if it's recognized by other shareholders or market participants and so on. And but right now the venture capital share is 0. So we should just have to turn this off. So originally we have only 1 million shares, not more. So share price should be just this number here. So without VC investor, without debt. So we can see that, okay, I was able to add 10,000 euros to the value of the company before we start to provide any kind of financing cushion, because we can see that we are barely surviving the first year. So if anything happens, then we will face losses. And how much cash reserve do we have? You can say that, yeah, but come on, we have 40 million euros, but this is so stretched out. So the total assets, if you are comparing cash reserve to total assets, this is practically 0. So I would take up some loan or some kind of funding is necessary to make this thing viable. Otherwise, this is much more like a gambling, not a proper corporate operation. So even if we are saying that, okay, let's collect 1 million euros as a debt, we know that this is practically a manufacturing cost for 3 launches. So we have a runway with 1 million euros only for 3 launches, and after that, if they are not successful, then game over. So that's why we have to be conservative. Otherwise, we can have the same fate like Astra or Virgin Orbit, that they were way too confident in their reliability, and then reality hit them hard. So this is that was the practice, and after that, next time we will continue with probability of default, and then we will compile the report from these 2 things, and after that we will be happy to submit the assignment 2.